amongst all the asset classes, right? I mean, if we divide asset classes in equity, debt, real estate, commodities, primarily gold, I personally believe, and I have a right to be wrong, that equities will be the largest asset creator, largest wealth creator as an asset class over the next decade, right? Okay. But how do you play it? If you don't understand this asset class, you can just go and buy a piece of gold, right, from the jeweler, or you can simply go and do an FD or your savings in post office, right? Those are simpler ways of parking your money. But equity is a very tricky game. It's not an easy game, right? I mean, which company to buy, what valuations to buy at, what time frame to hold on to, how do you know there is value in this company, how do you know the valuations are at peak, whether you should go direct or not. And that is the reason that every single retail investor entering the market has not been able to create value sustainably for himself or herself. I would suggest, so while I am a very big proponent, while I am a very big believer that a large part of the country should be having some portion of their savings in equities, but I definitely not recommend many of them to directly come in equity markets for the simple reason that they don't understand. See, if they burn their fingers, the problem is they come, they test the waters, they burn their fingers, they go back, and they don't come back for another 5-7 years, and by that time the country's markets have gone to a different level altogether, right? Just to give you some numbers in context, US on a 26 trillion plus GDP is having a market cap of north of $60 trillion, right? We are at a GDP of $3.5 trillion and our market cap is $4.2 or $4.3 trillion. As the country moves to $6 trillion of GDP, market cap 100% has to go from here. How much we don't know, that's for us to hazard a guess. But as the country moves from 3.5 to 6 trillion in GDP, market cap will grow. A lot of companies will participate in that growth and see their valuations grow. But which one will not? How do you differentiate a copper from a gold? It's not so easy, right? I would always recommend the retail investor, the smaller investors, to go indirect route. Now, indirect can be again active or passive. You can put money in some active mutual funds, or I would suggest an even better way is to go passive. Participate in equity markets, but be a passive investor, buy some ETFs, and sit quiet. End of the day, if the country has to grow, if the capital market has to grow, the benchmark indices have to give returns, right? At least be happy and contented with those returns rather than playing and burning your fingers. What's happening in options market is something very, it's very surprising. I don't know how many of them are net making money, net taking money home, or they are losing, or it's become more of a hobby than an investing process. So I would say that, larger set of retail investors must come in the market. But I would sincerely recommend first few years they should invest in passive instruments, right? Especially the ETFs, right? I mean, a Nifty ETF.
So avoid quick gains and look for more sustainable routes of making wealth.
Definitely avoid quick gains, especially if you don't understand the game. See,
and
you
avoid
have to first of all master the game.
Avoid speculation,
100%,
right?
100%. See, end of the day, things like quick gains, speculation, they end up destroying families. And because the mindset doesn't become the right mindset, then you are having a wrong mindset, right? Then you are not thinking of capital market as a place which can grow your wealth. You are thinking of capital market as a place where you get in, make some quick money, get out. That is not the entire intent. The intent should be when you do an FD, you don't go and stand outside the bank every day, right, to see how much your interest has gone up or down, right? Similarly, suppose you buy gold, you don't go and check the gold prices every day. Similarly, should be the idea, but then how can you do that? If the retail investor goes and buy a particular security on the market, any company stock, without even understanding that company, obviously every day, 5 times in a day, he or she will check the price of that security, right? But if you go passive, you simply go and put your money in a index ETF, you can simply be rest assured that, let's say, underlying capital markets overall market cap grows at 12, 14, 15% CAGR. At least some part of it, or a good part of that growth in percentage, would be reflected in the growth of the underlying indices also, right? So at least that much you are a participant.
Yeah.
If Nifty has given 10.5, 11% CAGR in the last 20 years, there is a reasonable possibility that in the next 7 years, as market cap goes from $4.5 trillion of the country to 7, 8, 9, 10 trillion dollars, the indices will also give at least 9-10% CAGR.
Yeah.
Over a period of time, that is good wealth generation.
Yeah.
Compared to, let's say, a plain debt instrument. And then the beauty of capital markets is that, these investors who will stay on for a longer period of time, whenever they are able to sell their units or stock or whatever, the country's tax regime is very benign, so they pay only 10% plus surcharge as capital gains tax. So end of the day, they will see a substantial wealth creation. But the point is they have to invest in the right way. They cannot be buying options or they cannot be investing in any security without understanding the underlying fundamentals and valuations and invest and then lose money and then crib. That is not the right way, I think.
Just on this point, in terms of statistics, about how Hemant sir mentioned about the United States. Today in India, there are roughly about, you can say about 14.5 crore Demat accounts.
Mm-hmm.
That means, and out of which about 8 crore are unique. So you can say 8 crore people have invested at least once in their life, right? Whether how active they are or not, we don't know. I mean, how much participation really is there probably comes from a lesser share of that, of those 8 crore Demat accounts. If you compare this in the US, about 60% of the people invest in equity markets. The population of the US is about 34 crore, around 340 million. And 60% of that is almost 15 to 17 crore people who are investing in equity markets in the US. In India, when you compare that number, we are not even at 6%. So participation, of course, has increased, like I also mentioned about the SIP.
Yeah.
So SIP growth also has been tremendous, but we are still far off from like the real potential of this country has still not been unlocked. We are just scratching the tip of the surface, you can say. There's a lot more to come when retail participation increases and in the right way, like Sir said. So retail participation doesn't mean that you invest in a particular stock because of hearsay. At the end of the day, it has to come from your own understanding of the business. And what they say is that if you have conviction in a business, if your own conviction is there in a business, no matter what happens to the stock price, you will remain invested because you truly believe in the business. If you invest just because of hearsay, tomorrow that particular stock falls 5%, 10%, 15%, you're going to sell it off. If you do it based on your own understanding of the business, that 5%, 10% fall in the share price is not really going to change your view about the company. So investing in the right way is very important, and I think retail participation will increase over time, but they have to be guided the right way. They have to be told how to enter Indian equity markets, and that sort of awareness is, I won't say it's lacking, but it has to be developed more.
See, price increase, everything is very rosy when someone makes money. But these are capital markets, these are equity markets. One has to always be cognizant of the fact that there are drawdowns also, there are corrections also. Sometimes they are very sharp. There are bear markets also. And when value comes down, see, sustainably markets will always go up. But when these phases come and value comes down, it's very painful at times, right? And for the uninitiated, it becomes double whammy, right? They don't even know whether to stay on, whether to exit, whether to book loss. And then it's not a very good experience, right? And that's why I say participate, but it has to be in the right way. Because a lot of them would not have seen what a bear market is. They would not have seen what a sharp correction is, right?
So dip your toes before jumping in the water.
Yeah, and definitely no leverage. Today youngsters, they don't understand. See, what is F&O? It's leverage, right? Right? Never. I mean, so first of all, there's a lot of room for financial literacy, for capital market literacy in this country. Sometimes people fear, they don't enter out of fear because they don't know. If they enter the wrong way and then they burn their fingers. So capital market literacy is a very, very important need of the hour, because we have to make them participate also and participate in the right way so that they don't burn their money, they grow it sustainably, slow and steady, but grow their money. But they have to be in the right instrument for that. Right? They can't be in wrong instruments, which is what a lot of youngsters are doing, which is actually making me a bit jittery about what they are doing with their money.